Welcome to the Deep Dive. Today we're digging into Deckers Brands, that's ticker DECK. We're focused right on their Q2 fiscal 26 results from October 23rd, specifically the earnings and that forward guidance.
Yeah, and it's a real head-scratcher we need to unpack for you. Deckers totally crushed the Q2 estimates. I mean, profit, revenue, both beats. But then, boom, the stock drops over 7% after hours.
Over 7%, okay.
So how does that happen? Beat the quarter, but get hammered by the market. That's the puzzle.
Right. Let's lay out the beat first. Q2 performance, it looked great on paper. Diluted EPS came in at $1.82.
Which was way above the consensus, right? They were looking for maybe $1.58.
Exactly. A solid 24-cent beat. That's up 14% from last year. Pretty strong.
And revenue, too, wasn't it? Net sales.
Yeah, net sales hit $1.431 billion. Also just squeaked past expectations, which were, around $1.42 billion?
So 9.1% growth year over year.
Yeah.
Or like 8.3% if you adjust for currency stuff. Still healthy growth.
And the margins looked good, too, didn't they? Suggests they're holding on to pricing power.
Yeah, gross margin actually went up a bit, 56.2%, up from 55.9%. And operating income climbed to $326.5 million. So you look at Q2 in isolation.
It looks like a win, a clear win.
It does. But, the market looks forward, not backward.
Yeah.
And that's where we hit the snag, the guidance, that 7.4% stock drop, almost entirely because of the full-year revenue outlook.
Okay, so what was the guidance number? How far off was it from what Wall Street wanted?
So Deckers guided for full-year fiscal 26 net sales of about $5.35 billion.
$5.35 billion, and the Street was looking for?
Closer to $5.46 billion. Some models were even up at $5.5 billion. So you're looking at, $110 million gap?
$110 million short on a $5.5 billion expectation?
Right.
That feels significant, but maybe not catastrophic. Especially when they just beat earnings.
Well, that's the really interesting part. The earnings guidance, the EPS forecast for the full year was actually okay.
It was. So they expect to make the profit, just not sell quite as much stuff.
Pretty much. They guided for diluted EPS between $6.30 and $6.39. The consensus was like $6.33. So their midpoint is right there, maybe even a tiny bit better.
Okay, so why the panic over revenue if the profit outlook is still on track? That seems weird.
It's about the story, right?
Yeah.
The market isn't just looking at current profit. Deckers has been priced for really high growth. So even if they hit the EPS number...
How they hit it matters.
Exactly. If they hit it because sales are booming, great. But if they hit it because sales are slowing and they're just managing costs really well, that signals the growth engine might be, sputtering a bit.
And they are guiding for good margins, right? Operating margin 21.5%, gross margin 56%. That's efficient.
Super efficient. But for a stock like Deckers, efficiency isn't enough. It needs that top-line velocity. Missing the revenue guide changes the narrative from hypergrowth to maybe maturing business, and the market reaction tells you it didn't like that shift.
Gotcha. Okay, let's dive back into Q2 then, because the details behind the beat probably hint at why that forward guidance is softer. The brands.
Yeah, the CEO highlighted HOKA and UGG. Both delivered double-digit growth again, which is, pretty impressive.
Okay, what were the numbers?
UGG sales were up 10.1%, almost $760 million. That's huge heading into their key season.
And HOKA, still flying.
Still flying.
Yeah.
Up 11.1% to $634 million. Those two are definitely the powerhouses.
What about the other brands? They were down, right?
Yeah, down quite a bit, 26.5%. But that was expected. They're phasing out the standalone Koolaburra stuff, so it's more like trimming the portfolio to focus on the big winners.
That makes sense. Strategic cleanup.
Right. But here's the big story from Q2, the one that really feeds into the guidance concerns. The geographic split. It was dramatic.
Okay, lay it out.
International sales absolutely exploded, up 29.3%, nearly $600 million. Huge momentum overseas. Europe, Asia, they're clearly gaining traction.
Wow, okay. Almost 30% growth internationally.
But domestic sales, here in the U.S., they actually decreased, down 1.7% to about $840 million.
Wait, decreased? Even with HOK and UGG growing globally, how does that work?
That's the million-dollar question, isn't it? You've got two super hot brands, but your biggest market, the U.S., is shrinking overall.
That sounds like friction. That definitely connects back to what some analysts were saying, right? About the American consumer maybe being tapped out.
Exactly. It suggests that maybe that boom in discretionary spending, especially on premium footwear, might be cooling off here at home, even for hot brands like HOKA and UGG.
And does the way they sold stuff back that up? The channels?
Yeah, it does seem to. Wholesale sales selling through other retailers were up strong, like 13.4%. So they pushed a lot of product out to partners.
Okay, but direct to consumer, selling on their own websites.
That actually went down. DTC sales dipped 0.8%, and comparable DTC sales like for like were down almost 3%.
Ooh, losing DTC momentum isn't great. Those are usually your highest margin sales, right? Cutting out the middleman.
Precisely. So it looks like they might be trading some of those high-margin direct sales for lower-margin wholesale volume. Helps the top line in the short term? Maybe, but it could squeeze profitability quality down the road.
Right. Even if the overall EPS guidance looks okay now, it's the quality of those earnings.
It's potentially trading quality for quantity. And if domestic consumers are pulling back, maybe buying from retailers offering discounts instead of direct, Deckers loses some control over pricing, so they need that international growth and wholesale volume even more.
Okay, so if things are potentially slowing down domestically, how's their balance sheet? Can they handle it?
Financially, they look pretty solid. Cash is strong, over $1.4 billion. And importantly, no debt. That gives them a lot of flexibility.
Okay, that's good. But you mentioned something raised eyebrows, inventory.
Yeah, inventories are up $835.6 million now compared to about $778 million last year. It's a noticeable jump.
What are people saying that means?
Well, there are a couple of theories floating around. One, the positive spin. They're just stocking up smartly for the big UGG season and ongoing HOKA demand, getting out of it.
And the less positive spin.
That inventory is building because U.S. demand is slowing faster than they planned, which could mean markdowns later. Or some analysts speculated they were front-running tariffs, bringing goods in early before potential new duties hit. Either way, it adds a bit of uncertainty.
Okay, that inventory question leads to another interesting point. What management did with their cash during the quarter. Capital allocation.
Right. They were buying back their own stock.
Yeah.
A lot of it. Spent $282 million buying back about 2.6 million shares.
Okay, buying back stock isn't unusual, but what was the price?
This is the kicker. The average price they paid was $109.31 per share.
$109.31, and the stock closed way below that after the earnings report and guidance, right?
Exactly. So management was out there buying aggressively at $109, basically saying, we think the stock is cheap here, but then they released guidance that made the market think, maybe it wasn't so cheap. That $282 million buyback looks maybe a bit premature now.
Shows confidence from management, maybe, but a disconnect with market expectations. Do they have more buyback power left?
Oh, yeah. They still have authorization for another $2.2 billion. So they can keep buying if they want. Their actions say confidence, but the guidance says caution. It's mixed.
Let's go back to that guidance one more time, then. Because the outlook for the two main brands tells a story, too, right?
It really does. It shows a clear split. HOKA is still expected to grow strong, low teens % for the full year. That engine is still firing on all cylinders, especially globally.
Low teens for HOKA, solid. But UGG, after putting up 10% in Q2...
The full-year guide for UGG is only low to mid-single digits.
Whoa. So that means they expect UGG to slow down a lot in the second half, the holiday season.
That's exactly what it implies, a significant deceleration for UGG right when they need it most for Q3 and Q4. The market reads that as a major headwind, potentially linked back to that domestic softness we talked about. It really explains why the overall revenue guide felt light.
Even with all the inventory, the domestic dip, the UGG slowdown implied the CEO still expressed confidence.
Yep. Standard CEO playbook. Confidence in hitting the outlook, citing innovation, great operating model, all that. But you got to look at the numbers they provided.
And the numbers suggest they'll hit the profit target more through efficiency and margin control, less through runaway sales growth.
That seems to be the plan, yeah.
Yep.
Tighten the belt, leverage the margins they have, rely on HOKA and international growth.
So let's bottom line this for you, the listener. What's the takeaway? Deckers Q2 was kind of two-faced, wasn't it?
Absolutely. You had fantastic international growth, HOKA still charging ahead. That drove the Q2 beat. But under the surface,
domestic sales went negative, high-margin direct sales softened, and the full-year revenue forecast spooked the market because it was below expectations. They're really banking on global expansion now.
And that guidance paints a picture of two different futures for their main brands. HOKA keeps running fast, but UGG, critical for the next 6 months, is expected to slow down quite a bit. That points to real pressure, maybe saturation, in the U.S. market.
Which leaves us with a final thought for you to chew on. The guidance pretty clearly signals that the U.S. consumer might be tapped out, at least for Deckers. They're leaning heavily on that impressive international growth. But the question is, will that be enough? With inventories also rising, can strong overseas sales truly offset the drag from a weakening home market in the crucial upcoming quarters? Or did this guidance reveal a friction point that's bigger than analysts currently realize? Keep an eye on that international versus domestic balance.